Hey, what's up, everyone? This is Kirk here again at Option Alpha, and sorry I haven't been in here the last couple of days. Just been busy with the girls and the kids, and so I wanted to get this chart to you guys and talk a little bit about the stock market and where it's at right now. We've seen a little bit of a sell-off in stocks. I mean, it's nothing really big, about 1% now across the board. And I think it's crazy because I just had a talk just the other day with a very close family member, and it almost reminds me of the shoe shine boy story, which anybody who's really interested in investing knows the story, right? Back in the Great Depression, some investor, I don't know who it was, some trader, basically went out to shine his shoes on Wall Street, and the shoe shine boy told him all the, stock tips and how he was making money, buying stocks left and right, and that was his signal to get out, right? And so I had a talk with somebody, very close family member, and they said basically the same thing. They're like, Kirk, why don't I just, sell everything and buy SPY? It just keeps going up. It just doesn't stop, right? And I'm like, okay, well, yeah, I mean, it's had a good run here, right? But what's the risk reward at this level, right? Where do you think we are at this level that, it could go up from here because you're buying in here and assuming that's going to go even higher than here, basically not buying in based on past, history, right? Like the move that's already made, it's already made, right? So I want to show you guys this chart tonight because I think it's important to see. And this is a chart that you really should be looking at on a quarterly basis, annual basis at the very least, right? Just kind of looking at where stocks are priced. And it's a PE chart, which most of you know is a price to earnings chart, but it's different because, see, what most people do when they look at PE charts is that it's really not on the screen here so you guys can see this. But a regular PE chart is not really normalized. It doesn't account for cyclicality, it doesn't account for business cycles, etc. So one of the ways that you can look at it is through what's called a PE10, and that basically means that it has some smoothing in it, some cyclicality as the numbers are kind of averaged out over 10 years. And so what you see here, and let me just go back here for just a second. So what you see here is basically the arithmetic mean of the PE ratio going all the way back to 1880 for the S&P, right? And so the mean is right around the middle, right? And so what we're showing here is all these different points in time and history, right? Compared to where we are at right now, which is March 2017. So you can see, right, that this was basically the crash in 29, right? So that was the crash in 29 right there. We were at basically a huge 95% run, right? And that was basically at that point about a 2 standard deviation move from the mean that it's had historically, right? So that was a huge, huge move and bubble, right? No doubt. And now looking back on it, you can see that, right? And then you have basically right here, you have the dot-com bubble, right? So that was the huge one here, which went really, really crazy, like a 3 standard deviation move, which is not surprising because companies were going public and they were based on, future forecasted earnings. I mean, not even that different than some of the companies that are going public now, like Snapchat and Twitter. Like these companies don't even make money and they're trading at ridiculous valuations, right? Not to say that they're not, you can't trade them for a little bit. I mean, but really, where's the value in those? They don't even make money. They're not even profitable, may not even be profitable, right? So that's where we were at, right, in 2000. That big peak right up here, that's where we were at in 2000. So where we are now is about a 73% run from the bottom and a huge, huge move. We're starting to approach the 2 standard deviation level. Now, we've only ever been to this level twice before in history, okay? Now, of course, as we saw in both the 29 market and also in the 2000 market, it doesn't mean that we can't run higher from here, right? So I'm not telling you sell all your stocks. I'm just saying get some knowledge behind what you're doing and make sure that you understand the risk reward that you're taking. If you're totally cool taking that type of risk reward with stocks right now, and this is generally across the board, by all means, knock yourself out. But again, we've only ever been to this level on a normalized, on a cyclical, inflation-adjusted level ever twice before in history, okay? So look, again, I'm not saying you sell out of all your stocks. I'm not going to say that the market's going to crash. But we are definitely approaching territory that is pretty scary as far as valuation. And if you're really a long-term investor, do you look at this and think to yourself, maybe this is not the best time to be buying in, right? Maybe you use options to hedge it. Maybe you just sell out of some stuff. Maybe use some stop loss orders, right? Do something that kind of protects what you have right now. So I wanted to show you guys that chart again, just because I think that again, get a sense of where we're at. I think a lot of people get lost in the weeds here, and it's tough. I mean, like myself included, like, I'm pretty young with my family and my girls, and I've got a long-term perspective on this. And believe me, it's hard to hold through a market that goes up, another 10% every year, right? And it's just really easy to do. But this level right here, and hopefully I'll just post this video again in like 5 years and say, "Ha, I told you, right? It was, we're at crazy levels." But you just look at the numbers and you basically, understand that where we're at right now, the risk reward just doesn't make sense, right? It just doesn't make sense as a long-term investor. So it's really hard to wrap my head around why people would continue buying at these levels. Again, not that it couldn't go up, because it definitely could, but it's just not a good risk reward at this level. So hopefully this was helpful. I appreciate it. If you guys like this, give me the thumbs up, the hearts, share this with maybe somebody that that might want to see this. So somebody who's investing, somebody's older, right, that doesn't want to go through some sort of 2008 crash right before they retire. Let's get this word out and help spread the word about what we're trying to do here at Option Alpha. So I really appreciate it. Thank you guys so much, and we'll talk to you guys soon.